Hello everyone and welcome to Financial Accounting. Ever wondered what the difference is between accounts payable and deferred revenue and how it really impacts your business finances? Accounts payable and deferred revenue are two crucial concepts in accounting and financial management that can make or break a business. Understanding the difference between them is essential for making informed decisions about your company's financial health. They play a significant role in determining your business's cash flow, profitability, and overall financial stability. Before we get started, thank you all for liking and sharing this video. It really helps out this channel. Please consider subscribing so you don't miss new videos. One common misconception is that accounts payable and deferred revenue are interchangeable terms. Many businesses struggle to differentiate between the two since both are liability accounts, leading to errors in financial reporting. These can have serious consequences such as incorrect financial statements, misinformed business decisions, and even regulatory issues. Another challenge businesses face is accurately recording and tracking these accounts. It's not uncommon for companies to misclassify accounts payable as deferred revenue or vice versa. The consequences of such mistakes can be severe. For instance, if a business incorrectly records a payment as accounts payable instead of deferred revenue, it may overstate its future expenses and understate its future revenue. This can lead to a distorted view of the company's financial performance, making it difficult to make informed decisions. Moreover, incorrect financial reporting can also impact a company's relationship with stakeholders, including investors, lenders, and customers. Diving deeper into the definitions, accounts payable refers to the amount a company owes to its suppliers or vendors for goods or services purchased on credit. It's a liability account that represents the amount the business needs to pay to its creditors. On the other hand, deferred revenue, also known as unearned revenue, represents the amount a company has received from customers in advance of delivering goods or services. It's a liability account that indicates the company's obligation to provide goods or services to its customers. In a company's financial statements, accounts payable is typically reported as a current liability, while deferred revenue can be reported as a current or a long-term liability. However, their impact on cash flows differs significantly. Accounts payable can help a business manage its cash flow by delaying payments to suppliers, while deferred revenue can provide a source of funding for businesses to invest in growth initiatives. The roles of accounts payable and deferred revenue in a company's financial statements and cash flow cannot be overstated. Accurate recording and tracking of these accounts are critical to ensuring the accuracy of financial statements. A clear understanding of these concepts is essential for making informed decisions about a company's financial health. So, what are the key differences between accounts payable and deferred revenue? Accounts payable represents amounts owed to suppliers, while deferred revenue represents amounts received from customers in advance of delivering goods or services. A real-world example can illustrate this difference. Suppose a company purchases inventory from a supplier on credit. The amount owed to the supplier is recorded as accounts payable. In contrast, if a customer pays for a subscription service in advance, the payment is recorded as deferred revenue. If you would like to learn more about deferred or unearned revenue, watch my video Master Accounting for Unearned Revenue in 6 minutes. I am posting the link here and in the description below. To illustrate the impact on financial reporting, consider a company that incorrectly classifies accounts payable as deferred revenue. This can lead to an overstatement of revenue in the future and understatement of expenses, resulting in a distorted view of the company's financial performance. Accurate classification and recording of these accounts are crucial to ensuring the accuracy of financial statements. And if we look at debits and credits, accounts payable is recorded as an increase or debit to inventory or expenses, and an increase or credit to accounts payable. When payment is made, it is recorded as a decrease or debit to accounts payable and a decrease or credit to cash. With deferred revenue, the picture is different. It starts with recording a cash receipt. It is recorded as an increase or debit to cash and an increase or credit to deferred revenue. When revenue is recognized, it is recorded as a decrease or debit to deferred revenue and an increase or credit to revenue. If you are not familiar with the rules of debit and credit, watch my video. I am posting the link here and in the description below. In summary, understanding the difference between accounts payable and deferred revenue is crucial for businesses to ensure accurate financial reporting and informed decision-making. If you've had any experiences with accounts payable and deferred revenue that you would like to share, or if you have any questions about these concepts, please leave a comment below. If you are interested in learning more about accounting and financial management, check out my videos on financial accounting tips and real-world examples to take your accounting skills to the next level. Thank you for watching, and I hope to see you all again in the next video.